All right, let's dive right into this explainer. Today, we're putting the massive British pharmaceutical giant GSK plc through an absolute relentless valuation gauntlet. As an investment analyst, I'm constantly looking for the ground truth behind a ticker symbol, you know? So we are going to evaluate GSK using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, alongside some really rigorous quantitative models. We're stripping away all the market noise to see if this stock actually deserves a place in your portfolio. Now, what's literally blowing my mind here is the sheer scale of GSK's ambition. CEO Emma Walmsley is confidently projecting sales of over £40 billion by 2031. And that's being driven by a huge wave of new approvals and a heavily reinforced product pipeline. It's a bold target, and it sets the perfect stage for us. We really need to figure out, has the market already priced in this rosy future, or is there still a hidden gem here for a savvy investor like you?
So here's our game plan. 1. Company snapshot. 2. The Buffett lens. 3. The Lynch lens. 4. The Graham lens. 5. Quant models looking at DCF and DDM. And finally 6. Synthesis and recommendation. Let's get to it.
All right, Section 1. Company snapshot. Let's meet the patient.
GSK is just an absolute titan in the global pharma space, right? Looking at their recent filings, the financial baseline is incredibly solid. They're guiding for turnover growth toward the top end of their 3 to 5% estimate. Core earnings per share are expected to grow near 8%, and structurally, they're operating with a trailing 12-month operating margin of nearly 23%. So, assuming a current market price of roughly £50 per share for our math today, we're looking at a highly profitable, mature beast of a company.
Moving right along to Section 2, the Warren Buffett lens. You know, Warren Buffett demands a few absolute non-negotiables: a massive economic moat, consistent earnings, and a management team that treats you like a partner. Applying this to GSK, the company shows a really solid moat. Their specialty medicine sales jumped 15% in just a single quarter. Plus, management is definitely shareholder-friendly. They just kicked off a massive £2 billion share buyback program. To fill in the gaps for our model here, we'll assume a stable industry average return on equity of around 15%, and with £8 billion in quarterly sales, their debt profile is totally manageable.
And honestly, this right here is the absolute bedrock of that economic moat. You do not get pricing power in pharma without non-stop innovation. GSK currently has an impressive 16 assets in late-stage phase 3 or registration development. They've already notched 3 major FDA approvals recently, including Penmenvy for meningitis and Bluejepa for UTIs. For Buffett, this constant replenishment of protected IP is literally the ultimate competitive edge. Qualitatively, Buffett would be very happy holding this.
But hey, qualitative is just one side of the coin. Let's flip it over to Section 3, the Peter Lynch lens. Peter Lynch loved putting companies into distinct buckets to understand exactly what he was buying. With its top-end growth of 3 to 5% and that massive £40 billion target, GSK fits perfectly into Lynch's definition of a stalwart. It's not some crazy fast grower that's going to double overnight, but it's a massive, established, defensive play that offers steady growth and downside protection when the market gets rocky. But here is where the math gets a little dicey. Lynch famously used the PEG ratio, price to earnings relative to growth, to spot value. If we assume an annualized core EPS of £1.86 at a £50 share price, we get an estimated PE ratio of about 26. When you divide that 26 PE by their 8% expected growth rate, boom, you get a PEG ratio of roughly 3.25. For Lynch, anything over 1 means a stock is getting expensive. At a PEG over 3, the pure Lynch investor is screaming sell, or maybe a generous hold, waiting for the price to drop to match that moderate growth rate.
Well, if Lynch thinks it's a bit rich, let's see what the godfather of value investing has to say. Section 4, the Benjamin Graham lens.
Graham is famously ruthless, right? His checklist for the defensive investor is super strict. Now, GSK easily passes his hurdles for adequate size, earnings stability, and a fantastic dividend record. They've literally guided for a sweet 70 pence per share dividend in 2026. However, it completely fails Graham's requirement for moderate price to earnings and price to book multiples. The market is simply pricing in way too much of a premium for Graham's blood.
And we can literally prove this by running his famous intrinsic value formula. You take the square root of 22.5, multiplied by the earnings per share, multiplied by the book value per share. Using our assumed EPS of 1.86, and assuming an industry average book value of £15 per share just to fill the gap, we calculate an intrinsic value of exactly £25.06. With the stock trading way higher than that today, Graham looks at this and sees absolutely zero margin of safety. It is a hard pass for the strict value investor.
Okay, enough from the gurus. Let's put on our lab coats and run the pure quant models. Section 5. Quant models, specifically discounted cash flow and the dividend discount model.
Since management gave us such stellar forward guidance, we can build a really strong base case DCF in 4 quick steps. First, we forecast cash flows using their 8% core growth target. Second, we calculate a terminal value assuming a highly conservative 2% perpetual growth rate. Third, we discount it all back to today using an assumed 8% weighted average cost of capital. And finally, we divide by the actual Q1 share count, 4,023 million shares, which is heavily supported by that buyback program we talked about.
And that brings us to this beautiful sensitivity table. This matrix shows you exactly how tweaking our assumptions changes the fair value. Look right in the center there. At our base 8% WACC and 2% terminal growth, the DCF spits out a fair value of about £52.40 a share. So from a purely forward-looking cash flow perspective, the current market price of around £50 makes total sense.
But wait, what if we only value the actual cash hitting our pockets? For our second quant approach, we use the dividend discount model, or DDM. We take the explicitly stated 2026 dividend of 70 pence. If we assume a historical long-term dividend growth rate of 6% and keep our 8% cost of equity, the DDM lands at a fair value of just £35 per share. By this metric, the stock is overvalued. We'd need a higher dividend growth rate or a cheaper stock price to make the math work.
All right, we have gathered a mountain of data. Time to bring it all together. Section 6, Synthesis and Recommendation.
This master matrix is fascinating because it reveals a really stark divide in our analysis. The forward-looking quantitative DCF model and Buffett's qualitative mode assessment both lean towards a hold or even a mild buy. But on the flip side, the strict historical math of Peter Lynch, Benjamin Graham, and the dividend discount model, they are screaming sell. They just demand a much bigger margin of safety than £50 gives us.
So synthesizing the whole shebang, my final opinion has to be a hold. Look, the fundamentals are stellar. That phenomenal R&D pipeline with 16 late-stage assets and a rock-solid growing dividend. But we can't ignore the risks. The valuation multiples are visibly stretched, and the company's own filings flag an uncertain environment regarding potential U.S. and European tariffs. Basically, you're paying a premium price for a premium company right now, leaving very little room for error. Wait for a broader market pullback to get a real margin of safety before you initiate a new position.
So I'm going to leave you with this final question. Which guru are you? Are you a forward-looking visionary like Buffett, totally willing to pay a fair price for a wonderful business? Or are you the uncompromising mathematician like Graham, demanding a steep discount? You've got to answer that for yourself before making your next move in the market. Keep learning, keep analyzing, and I'll catch you in the next explainer.